More than $2.5 trillion in market value gone in just 2 days. Headlines are soaring saying big tech's cash burn is too big to ignore. But is this sell-off overblown, and is there a deeper story brewing long-term? MarketBeat analyst Thomas Hughes joins us with his take on what's happening behind the scenes with the hyperscalers and what their long-term story could look like. He's going to dive into 3 specific names later on in this video. Now, Thomas, I want to start out with looking at where the market is right now in this reaction to big tech.
Well, right now, the market a few weeks ago hit a peak, and we seem to be struggling to regain traction. The fears of the data center build out and the spending, the impact on debt and balance sheets and cash flow is really giving the market some pause.
Yeah, you can absolutely see that pullback in the heat map over the last 7 days or so, really concentrated on big tech. You look at Oracle, it's down more than 14% in the last 7 days of trade. Google's down almost 4%, and a lot of red in that big tech sector. Even the green spaces are only seeing slight increases right now. This comes after what we saw a huge boom in these big tech names last month. So want to get to what's behind the pullback that we're seeing. And one headline that keeps popping up is the cash burn, how much money these hyperscalers said they're spending. All of those details came out during those Q2 earnings reports. So what's your take when you look at that cash burn right now, Thomas?
Yeah, so right now, roughly speaking, over the last 18 months, hyperscalers and AI infrastructure companies have taken on about $750 billion in debt, including dilutive actions to try to raise capital for the data center build out. They're using their free cash flow to do this. The new debt load is also impairing their free cash flow. They're having to divert cash flow to these debt maintenance. They're also have historically bought back a lot of shares, and the money that's going to share buybacks is also going to this debt maintenance, and that's really impairing the cash flow. I think you showed me a chart earlier today where the cash flow went from being way up here to way down there, and that's really, really a scary thing for investors to look at, especially in the near term. It's certainly a headwind for the market, for market sentiment, and for share price action.
Yeah, that chart was from an article on Yahoo Finance today. Kudos to Yahoo for this chart and looking at this comparison. We know it's not just this last quarter, the amount of money that they're spending, but they've been investing for the last few quarters tremendous amounts of money into this AI build out. I think the biggest question, and that's really the thesis of this video, is there a long-term payout for these companies? Is this a huge bet and a huge risk that they're taking on, or will it pay off in the future? That's the biggest question that every investor has. And we're going to break down that question little by little. It's a big question. So let's start a little bit with, do you think that there is a risk for hyperscalers right now with this amount of cash burn?
There is a risk because it is a lot of cash. It all comes down to execution. They need to be able to build out these systems and bring them online and then to monetize them. Now, in the realm of risk, these companies aren't as risky as emergent tech stocks. This is not some new technology, emergent technology, where they're having to establish a business. This is the evolution of current technology. Every single one of the major leading companies are involved with this shift. They're all working together to make it happen. So in that sense, it is de-risked. Technology is moving this direction. It's not about having to prove it. It's just a matter of building it and getting it up and running and monetizing it. So to me, risky, yes, but it's an execution story. The risk will be reflected in periodic price corrections, not so much in stock price implosions. I think over time, these companies will continue to trend higher.
Yeah, I think that's what the market has gotten used to, is these companies really leading the market, really outperforming the market with how well they're doing. They've gotten used to those stock buybacks. They've gotten used to the benefits these hyperscalers have had of continuing to grow at the pace that they're growing at. But this new investment cycle that they're doing of having to invest so heavily in building out the AI story is a little concern for investors. And one thing I want to mention is retail investors, when we talk about hyperscaler stocks, they're like, I don't want to talk about Google. I don't want to talk about NVIDIA. These are boring stocks. But even if you are a retail investor, I think it's important to say these are stocks that pretty much every investor owns. Whether you're buying stocks on your own, if you've got a 401k of any kind, these stocks are so deeply entrenched into every ETF, every major system out there, that I think everybody owns a piece of these stocks. And so everyone wants to be prepared on what could this mean for their portfolio.
Right. You're totally right. These stocks, everybody owns them. They are the biggest revenue producers, cash producers. They have really visible growth stories. Investors that don't own them outright probably own them in an ETF or a fund. So as you're buying them, you keep that in mind. You may want to get exposure to some of these stocks, but you may already have it.
Yeah, and we'll talk about whether getting exposure or buying any dips that we see in these hyperscaler names. And Thomas is going to get into some specific companies here in just a minute. But first, Thomas, I want you to get into your theory on whether the cash burn happening right now is a real concern for investors, or whether you think it tells a deeper story long term.
It tells a deeper story long term, and evidence of why this isn't like an emergent tech story, but really the evolution of tech is the backlog. All of this spending, all of this new debt, this data center built out isn't in the hopes of business coming, it's to fulfill business that has been contracted. So while the debt has been blossoming, the backlogs for all these companies has been blossoming at an accelerated pace. So right now, over the same period, backlog amongst hyperscalers, AI infrastructure companies, from chips through the nuts and bolts plays, through the GPU as a rental companies, is about 2.1 trillion. That's about 3 times the debt raise. So the long-term outlook is for them to convert that debt into this revenue, which is 3 times as much. So we're looking at pretty robust growth over the next few years. At the same time, debt levels will come down, free cash flow will come down, growth will be accelerated. They'll be able to start reaccelerating share buybacks at the same time. And then you have to think that this backlog is contracted for a set number of years. So we think that this 2.1 trillion is probably good for the next, 3, 4, 5 years. Once they run out, there will be new contracts. There won't be any new debt because the data centers will already have been built. There'll just be new contracts with even better margins. So to me, the long-term outlook for AI, generally speaking, is very, very robust.
All right, looking at the backlog is really interesting. And we're not just talking about the backlog for the companies that are doing the physical build out themselves, right? We know that Google, Amazon, Meta, they're investing in the build out of a lot of these places. So it's kind of transferring money from these big tech companies to some of those infrastructure picks and shovels companies that we talk about all the time, the ones that are seeing tremendous growth
Well,
right now. Well, we know that their bills are getting paid because the hyperscalers are paying them. But do you see that backlog also showing up for the hyperscalers?
Oh, yeah, it's throughout the stack. So it's not just for the GPUs that underpin AI, and not just for the nuts and bolts that put the GPUs together in the data centers, but for the actual capacity. These big hyperscalers, these big software as a service companies have already and are continuing to contract this capacity, and they're the ones that are really underpinning the growth, because it's the demand for the capacity that drives demand for the infrastructure. And so right now we're in the infrastructure build out, and the long-term play is to transition from the infrastructure build out to the usage of capacity. When we start using the capacity, we'll start to convert that backlog really meaningfully into revenue and to earnings.
Yeah, there's no question that demand is there for more AI compute space. There's so many use cases popping up for businesses, companies, even retail investors are starting to use AI on a daily basis to get new ideas, especially those who are looking for short-term trades. One of our regular guests, Keith Kaplan, the CEO of Tradesmith, has a new super AI program that has been incredibly successful. It has a 73% historical accuracy rate after scanning over 2,300 individual stocks down to the penny. This is kind of built like weather software where they predict where storms are coming. This program helps to predict where a storm could be coming in the market. And again, it's incredibly accurate. And there is a new storm brewing, according to the software, coming up at the end of June. So by June 29th, make sure to check out this special offer for our MarketBeat viewers for Tradesmith. You can see a free demo of how this predictive software works. They'll give you a stock to look at too that can move on this June 29th deadline. So if you want to scan the QR code or click the link in the description, you can check out this new AI software for yourself and see which stocks they are expecting to move on this June 29th catalyst that their AI system has predicted. Again, it's a special offer just for our MarketBeat viewers. Scan the QR code or click the link to see how it works. So Thomas, clearly this is just one of many ways that people are using AI right now and increasing that demand for AI. And that means that they need to build the capacity for these programs to exist. And so that's why we see these hyperscalers investing so much in this build out right now. Google is one of the perfect poster childs for this. They're spending so much on AI right now. But I think the question that investors have is, how are they going to monetize that? So let's get into Google first. Where do you think that their monetization story plays out down the road?
Yeah, I mean, Google's a good example. You look at the charts, I think all the Mag 7 have pulled back pretty good right now, NVIDIA included. But I think this is just a natural mechanic in the between earnings cycle period. The market rocketed pretty robustly since the last earnings report, setting itself up for a correction. So right now, the market is again setting up for to me, another upswing. We're expecting earnings to come out, kind 3 or 4 weeks from now, and all the reports should be pretty good. They should affirm the trends that show, solid spending plans, plans for data center capacity, and also demand for the end market capacity for the end market users.
I think that's one thing that I've heard talked about a little bit is that in these earnings reports, it's good news for the AI build out story because when Google reports, they show how much money they are investing into this build out. But are they doing a good enough job, these hyperscalers, during that earnings call to really detail how this investment they're making is going to lead to more revenue for Google itself later on?
Yeah, I think generally speaking they are because these contracts are all very back ended. They're all dependent on future capacity. You have to think that current capacity is already maxed out. That's what's driving some of the price increases. So a lot of these contracts are based on future capacity and future technology. A lot of these data centers will be built using the Vera Rubin products, which are only just now coming out. Also going to be built on the AMD MI450 products, which have not yet come out. So you have to think that, this backlog is $2.1 trillion, but a lot of it's not going to start being recognized as revenue until late next year, early 2028, as these new data centers come online and we're able to start converting that capacity into actual revenue.
Yeah, that timeline is an important one for investors to keep in mind because hearing that converting to revenue is still a year or 2 years out makes me wonder if we're going to continue to see this kind of volatility happen in some of these giant tech names where they're going to lose some of their market cap simply because investors aren't ready to hold on to that risk until they see the payoff coming. Do you think that that volatility is going to continue and the speculation and fears about how much money they're spending before we get to that revenue point could continue for another 1 to 2 years?
Yeah, I think we will see some volatility continue over the next few quarters. I think that we're going to continue to see the AI bubble swell. That's going to drive some pretty solid upswings. In between the earnings cycles, there's going to be plenty of opportunities for the market to grow concern or to have some caution or just simple profit taking set in to provide pullbacks. But I think in this environment right now, price weaknesses will be buying opportunities because down the road there will be more catalysts, not just today's results and the guidance, but the actual conversion of these backlogs into cash flow and to earnings to drive the stock prices higher over time.
All right, so we talked about Google. Let's talk about a few other specific companies that you are looking at right now. I know one of those is Oracle. You just had an article out about the pullback we're seeing there. And this is one example of a company spending quite a bit of money on this build out right now.
Yeah, Oracle is one of the poster children for this story. It has really been leaning hard into debt, but it's also got one of the most aggressively growing backlogs. For me, Oracle is one of the premier stories here because it's being elevated not just from a legacy tech company to a new modern cloud-based AI tech company, but also from like a smaller niche player to being really central, top line, critical blue chip tech player, central to AI and data centers. Oracle is the hyperscalers serving the hyperscalers. It provides high capacity compute, high performance compute to all the other major hyperscalers, to Meta, to the AI laboratories, as well as to businesses and enterprises. And that's just the cloud business. Its actual core business, which is database services, is ubiquitous across the cloud. It's integrated into all the major hyperscalers' systems and networks. It is the most readily available database globally, and that just entrenches it to me as a very key, critical, primary player in the entire AI infrastructure and industry.
Do you think that Oracle holds more of a risk than Google or some of the other Mag 7 names simply because it didn't start with the kind of balance sheet that these giant Mag 7 companies did?
I don't think it has a risk. Its balance sheet was actually fairly healthy before this started. It was buying back shares pretty aggressively. There were some concerns with some of the metrics, but that was just offset by the cash flow and aggressive share buybacks. I think right now the biggest concern is just that the debt is swelling. It's going to be an impairment for the next, 12, 18 months, probably, maybe longer. But like I've been saying, they're going to start recognizing their backlog as revenue beginning next year and ramping that over the next few quarters. And that's really going to, whittle down that debt real fast. So I think the amount of stock price pressure that we've seen this year will be reversed and reflected in stock price increases in the upcoming years.
All right, well, let's look at the chart action for this one in particular. We started the video saying this one's down about 15% in the last few days, and that's just the start of the volatility it's seen over the last year. It hit a new high back in September, and it's been on a volatility swing ever since then. This would be a great company to sign up for our SMS text alert system. If you are a regular viewer, you may have seen us say you can text YouTube to 68285 to sign up for MarketBeat's text alert system. It'll let you know anytime a stock on your watch list has a major move in either direction. Again, Thomas, this is a good one to sign up for that alert system for because it has moved so much in both directions. But which way is it headed next? Do you think that this is the start of a potential deeper downtrend for this stock, or is it a good bottom that investors should look at buying?
Oh, this is not the start of a downtrend. This is, to me, absolutely a buying opportunity. What I see in Oracle's chart is last year was that big, huge price run up based on the swelling backlog. Since the peak last year, the price has pulled back, but that's due to fears of the debt. Since then, we're showing a pretty clear bottom. We are pulling back this week, the last few weeks. But within this, to me, what I'm seeing is a head and shoulders bottom. I'm seeing a market that's incredibly oversold, overreacted to the fears, totally set up to rebound, and all we need is a catalyst to drive it. Oracle is a mid-cycle reporter, so it actually reported not too long ago. It'll be quite a few more weeks before it reports again. It'll be after all the other hyperscalers report. But to me, all those other reports will be catalysts for Oracle because they're all going to be talking about their spending, and some of that spending is going towards Oracle for Oracle's own hyperscale buildup.
I know you mentioned that Oracle won't be reporting for a while, but the big earnings report that everyone is looking forward to today is MU. The Micron report comes out at market close today. We're recording this just before market close, so we don't have that report yet in this as we're talking about this. But I'm sure everyone has high expectations on how much of that spend is going towards companies like Micron and companies like these chip and memory stocks out there. So does that have any impact or connection with Oracle or this broader story about this massive investment going on right now?
Right now, a lot of money is going into the chips and not just into the GPUs or the memory, which is what Micron is making. Micron stock itself just hit a high this week. It's pulled back from that high kind of ahead of the release. But to me, this chart is very bullish. With Micron, we're expecting to see them show continued high level demand, potentially pushing at their own timeline to be able to meet capacity. Right now, they're sold out through the end of next year. This report might extend that into 2028. That's really supporting the outlook for prices, which is helping to drive Micron's business right now. Not only is it the volume of sales, but also the price that it's receiving. But then looking at the broader chip sector, generally speaking, AI is driving demand across the board. I mean, every kind of chip that you could imagine is needed to build these data centers and then to help apply AI long term through the IoT and through AI applications, because the GPUs are just the product that does like the computing. Then you have all the chips that are needed to connect the GPUs together, connect the servers together, connect the data centers together, power control devices, and all the actuators and all the servers that help to drive the Internet of Things. Because AI is really going to be about the application of physical AI and IoT, which is using that computer brain to make machines do jobs remotely all around the world.
Right. It can even take over your job as an investor. So many investors are using AI, much like that predictive AI program we just talked about from Tradesmith. There are so many use cases for how demand for AI is just continuing to grow because as people use it, they find it's incredibly successful. Again, a reminder about that QR code or that link if you want to check out that predictive AI software from Tradesmith. You can do that with a special offer in this video. But Thomas, the question is how much longer can this super growth cycle really continue for these companies?
Within chips, the chip industry is in a massive super cycle that was driven by inventory normalization and now boosted by AI. That should last for years until they're able to start, ramping capacity to meet the demand. As far as memory chips go, it's going to be at least another year or so before they're able to really significantly ramp capacity to meet that demand. And that's just going to continue to drive success for chip makers over the next, year or so. But then you look at it longer term, AI is driving a virtuous cycle. That's where spending on AI creates new capacity and new technology that improves the output, which means that you can spend more money on new chips to do the same thing over and over again. So each time that we go into a cycle and spend some money to advance AI, the outputs help us advance technology to the point that we're going to spend some more money to do the same thing over and over again. And right now, it looks like the virtuous cycle in AI could last indefinitely because we're really very early in this thing, and we really even haven't built out the first generation of AI data centers. That's what we've been talking about. That first generation will start coming online sometime next year.
That's a really good point to bring it back to that fear that so many investors have in the market right now is that all of this money is being invested into building out this first generation of data centers, like you said. But how quickly will those data centers be obsolete? Will they get the use out of them that these hyperscalers are expecting? Or will there be something new by the time that this build out is done? And I think that infrastructure piece, that unknown of how quickly everything is developing, is one of the other fears that so many investors have in the market and why we see the market react. So, what do you say to those fears of when this build out is done, will it pay off or will there already be something bigger, newer, and better that they need to pivot to?
In the tech world, once these data centers are built, there will be something better coming down the pipe, but it takes time for those things to happen. You got to think that this current AI data center boom has been building for the last couple of years, and it really hasn't borne any fruit yet. And we have had seen some fruit. We've seen some companies serious demand for their infrastructure products, but those data centers really have not yet been built. And so the application of this technology is still to come. Once that part happens and we're starting to apply that technology and they're monetizing it, then we'll start seeing some of that monetization begin to shift towards the next generation products. And then we might see another super cycle form.
So, Thomas, you are still very bullish on a bright future for the Mag 7, for the hyperscalers, and all of these stocks. You don't think the story is anywhere close to over, or there's too much risk built in to the future for these companies?
This cycle is not over. I think that tech stocks have a long, bright future ahead of them, especially the blue chip operators. As we see with AI, there's going to be changes in the technology, but they're all very well positioned to roll with the punches and to drive that transition. They definitely have the money and the scale and the scope to make it all happen.
All right, Thomas, thanks for this discussion today. I'd love to hear your thoughts too. Are you concerned about all of the money going into this AI build out? Do you think it'll pay off long term? Do you think these cycles will just continue to cycle through new technology and new advancements? Let me know your thoughts and join the conversation in the comments. That's what we love about this MarketBeat YouTube community. And if you want to hear some other thoughts about the memory sector in particular and how much longer the Micron and Seagates of this world could continue to see some tremendous growth stories too, make sure to watch this video with Louis Navalier from Growth Investor. He has a lot to say on how much longer the growth cycle could continue in these names. You can watch that full interview here.